There is a feeling that haunts every modern investor. You look at your brokerage account and the numbers are at all-time highs, but you look at your life, the cost of housing, insurance, energy, and food, and you feel poorer. This is not in your head, and this is not just inflation. This is a structural shift in the life cycle of the empire you live in. 600 years ago, a scholar named Ibn Khaldun wrote the Muqaddimah. He didn't just record history, he treated civilization as a biological organism. He proved that empires don't just happen, they follow a mathematical algorithm: birth, growth, senility, and death. We are not here to predict a crash. We are here to diagnose where we are in that life cycle. Because if you apply a growth phase strategy in a decay phase economy, you will be slaughtered.
Let's diagnose the anxiety you are feeling. Why does the market go up while the real economy struggles? Ibn Khaldun describes the transition from stage 2 to stage 4. Stage 2 is the builder phase. In this stage, wealth comes from productivity. You build a factory, you invent a machine, you improve the soil. The government is small, taxes are low, and capital flows to the risk takers who create tangible value. This was America in the 1950s. But then comes stage 4, the senility phase. In this stage, the easy growth is gone. The bureaucracy bloats. To maintain the illusion of growth, the system shifts from productivity to financialization. Look at the S&P 500 today. How much of that growth comes from selling more products? And how much comes from financial engineering, stock buybacks, zero interest leverage, and lobbying for regulatory moats? In stage 4, the smartest minds don't become engineers, they become compliance officers, tax attorneys, and lobbyists. Capital doesn't go to R&D, it goes to asset inflation. This explains the disconnect. The asset economy, stage 4, is booming because it is being pumped with liquidity. The real economy, stage 2, is suffocating under the weight of the overhead. You feel insecure because deep down you know that wealth generated by a printing press is not the same as wealth generated by a factory.
So, how does a stage 4 empire sustain itself when productivity slows? It begins to eat its own citizens. Ibn Khaldun famously described the tax cycle. At the beginning of the dynasty, taxation yields a large revenue from small assessments. At the end of the dynasty, taxation yields a small revenue from large assessments. We know this today as the Laffer curve. But in stage 4, the government hits a wall. They raise taxes, but the economy stagnates, so revenue drops. So they turn to the ultimate weapon, the invisible tax. They print the difference. Every dollar printed is a microscopic tax on your savings. It is a transfer of purchasing power from the saver to the state. But here is the deeper danger for investors. In stage 4, the government becomes your competitor. When the state runs massive deficits, it has to sell trillions in bonds. It sucks the oxygen out of the room. It crowds out private investment. Why would a bank lend to a risky small business when it can lend to the government? This creates a distortion called return-free risk. In a healthy market, government bonds are risk-free return. In a stage 4 market, where the debt is mathematically unpayable in real terms, bonds become certificates of guaranteed confiscation via inflation. You are not just fighting the market, you are fighting a leviathan that needs your capital to survive. So, how do you navigate a world where the currency is being debased, productivity is stalling, and the state is hungry? This is not a time for optimism, it is a time for positioning. Before we discuss specific assets, we need to reset your expectations. Most investment advice you hear today is designed for stage 2, the growth phase. It assumes the wind is at your back. But investing in stage 4, the phase of senility, is a different game entirely. It is not about maximizing returns. It is about minimizing irreversible mistakes. This is not a bull market playbook. This is a survival manual. In a decaying empire, the goal isn't just to make money. The goal is to ensure your purchasing power survives the government's desperate attempts to save itself. Here are the 4 strategies to navigate the decline. Strategy 1. Long the real, but beware the fake real. Ibn Khaldun taught that when the dynasty crumbles, the currency becomes a political tool. The ruler debases the coin to pay the army. Today, we call this quantitative easing. The obvious move is to short the currency, long the real. But here is the trap most investors fall into. They think stocks are real assets. They are not. Not all equities are created equal. A tech company with 0 tangible assets trading at 100x earnings based on cash flows projected 10 years from now, that is not a real asset. That is a long-duration promise priced in a weakening currency. When inflation spikes, those future cash flows are discounted to 0. To long the real in stage 4 means owning things that cannot be printed. Energy, commodities, arable land, gold. These are assets that have value even if the currency collapses. Everything else is just a paper claim on a system that is losing its solvency. Strategy 2. The Cantillon strategy. Dating, not marrying. In stage 4, the government becomes the biggest spender in the economy. Money doesn't flow evenly. It flows to specific favorites: defense contractors, subsidized green energy, and too-big-to-fail banks. This creates the Cantillon effect. Those closest to the money printer get rich first. The rest get inflation. Your strategy: stand next to the printer. Invest in sectors that the government must save or must fund to maintain power. But here is the warning. These are not free market companies. Their profits depend on political whims, not efficiency. This is a tactical play, not a buy and hold forever. Cantillon assets are rented, not owned. You ride them while the printer is on, you exit the moment the narrative changes. You date them, you don't marry them. Strategy 3. Jurisdictional arbitrage. Your capital must migrate. Ibn Khaldun observed a universal law. When the city becomes oppressive with taxes, the merchants leave. Today, you don't necessarily need a second passport to leave. Your capital can travel instantly. This is called jurisdictional arbitrage. This doesn't mean you have to move to Vietnam, India, or Brazil. It means your portfolio must have exposure to stage 1 and stage 2 demographics. Look at your stock holdings. Are you buying companies that sell diapers to shrinking populations in Europe? Or are you buying companies that sell technology to the exploding middle class in Southeast Asia? You can stay in New York or London, but your money should be working in places where the population is young, the debt is low, and the asabiya, or social cohesion, is still rising. Don't bet your entire future on a single aging empire. Strategy 4. Own true pricing power. Finally, the most critical defense against the invisible tax of inflation: pricing power. Wall Street loves to talk about brand loyalty, but in stage 4, loyalty dies when hunger begins. You need to distinguish between popularity and power. Popularity is when people buy your product because they like it. Power is when people buy your product because they have to. True pricing power is the ability to raise prices without losing volume. If inflation hits 10%, can the company raise prices by 12% and keep its customers? If the answer is no, that company is a victim. If the answer is yes, that company is a fortress. In a decaying economy, you want to own the toll booths, the energy grids, the essential medicines. Boring? Yes, but in a storm, boring is the only thing that keeps you alive.
Let's wrap this up. Understanding Ibn Khaldun is uncomfortable. It forces us to accept that nothing lasts forever. Not Rome, not the British Empire, and not the current financial order. In stage 4, the biggest risk to your wealth is not market volatility. The biggest risk is loyalty. loyalty to a currency that is being debased, loyalty to a government that sees you as a tax source, loyalty to investment narratives that worked in the golden age but fail in the age of decay. You don't need to be a pessimist, you don't need to build a bunker, and you certainly don't need to hate the empire. You just shouldn't go down with it.